Good afternoon, everyone. My name is Raksha Rai. I'm studying Master in Professional Accounting Services in IMC Sydney. During my this semester, I enrolled corporate accounting, and we are assigned to make a video presentation. In our team, we are five people, including me, Nisat Adhikari, Rajesh Sharma, Suman, and Ashok Pandey. Our team is expected to discuss accounting profit and taxable profit in our presentation. Every year, companies in Australia generally expect to have to pay part of their earnings to the Australian government in the form of income tax. However, the amount paid for a year is really the amount reported as income tax expenses in the statement of profit and loss and other comprehensive income for the year. Accounting profit. Accounting profit and taxable profit are two different measures of a company's financial performance, and they differ primarily because of the distinct accounting rules and tax regulations that govern their calculations. Here's an explanation of how these two types of profit differ. Accounting profit. Accounting profit is the profit calculated using generally accepted accounting principle or international financial report standards. It represents the financial performance to a business from an accounting perspective. It takes into account all revenue and expenses recognized in companies' financial statements, regardless of what when the cash is received or paid. Taxable profit. Taxable profit, on the other hand, is the profit used for tax calculation purposes. It is based on the income tax laws and regulations of the country where the business operates. A taxable profit often includes certain adjustments to accounting profits, such as tax deductions, credits, and exemptions. Which can significantly differ from the accounting treatment of these items. So there are many differences between accounting profit and taxable profit. Accounting profit recognizes revenue and expenses based on the accrual method of accounting, which means that income and expenses are recorded when they are on or incurred, regardless of when cash actually changes hands. Whereas taxable profit, in contrast, may use in cash method or modified cash method for recognizing income and expenses. This means that the certain income and expenses might be recognized for tax purposes when the cash is received or paid rather than when they are earned or incurred. Accounting profit may be depreciation and amortization methods based on GAAP or IFRS, which might differ from the tax depreciation methods. Taxable profit often uses specific tax depreciation methods that may result in different depreciation expenses affecting the taxable profit amount. Accounting profit is reported in the company's financial statements and is primarily used for external reporting to shareholders, creditors, and other stakeholders. Taxable profit is reported to tax authorities and it is used for circulating income tax liability. It is crucial for tax compliances. In summary, accounting profit and taxable profit differ due to variation in timing of recognition, treatment of non-taxable item, depreciation method, and reporting purposes. It is essential for businesses to understand these differences to ensure compliance with tax laws and to make informed financial decisions. Consulting with tax professionals or accountants is often necessary to manage this complexity effectively. For further information, I would like to hand over my friend Nisa Adhikari. Thank you.
Hi, my name is Nishat Purathaki, and in this assignment in corporate accounting, I'm presenting about question number 2. Um, so, I'm, my question is, will the income tax expenses for an accounting period be the same as the income tax payable at the end of the accounting period? So, the income tax expenses and income tax payable for an accounting period are related but not necessarily the same. They serve distinct purpose in financial reporting and tax compliance, reflecting the difference between accounting principle and tax regulations. Income tax expenses is an accounting concept used to allocate the expected tax liability associated with a company's financial performance during an accounting period. It is calculated based on the applicable tax rates and law, as well as the company's taxable income as determined by general accepted accounting principles. Income tax expense appears on the company's income statement and reflects the anticipated tax liability for the period. Income tax payable, on the other hand, represents the actual amount of tax a company owes to tax authorities based on tax laws and regulation. It considers specific tax credits, deductions, and adjustments allowed by tax authorities, which can result in differences from the income tax expenses calculated using GAAP. Income tax capable is reported as a liability on the company's balance sheet until the actual tax payment is made to the tax authorities. Several factors can contribute to the differences between income tax expenses and income tax payable. Timing differences, tax law changes, tax credits and deductions, permanent differences. However, while income tax expenses and income tax payable are related, they often differ due to the complex interplay of accounting principles and tax regulations. These differences highlight the importance of accurate financial reporting and tax compliance for businesses, as they impact a company's financial statements and cash flows. In this question, will the income tax expenses for an accounting period be the same as the income tax payable at the end of the accounting period? So the answer will be no. The income tax expenses and the income tax payable are not necessarily the same for accounting period, because income tax expenses means it's the amount of tax that is companies anticipated it will owe based on its accounting profit for the period, and income tax payable in other hand means the actual amount of tax that the company owes to the tax authorities for the period. So now my friend Raj is gonna present about question number 3. Thank you.
Hey, my name is Rajesh Sharma Sapkota, and here we are going to talk about the part 3 of our assessment, which is question number 3. And in this question, it is asked that how some big companies potentially does not pay taxes to the relevant taxation authorities. So there may be basically many reasons behind it. In this, we are going to talk about some of them, how successful companies or many companies, profitable companies, pay zero tax or pay less tax, and how they do it. So the first point would be some companies strategically leverage tax credits and make deduction in their entries and balance sheet statement, and also sometimes carry loss carry forwards, because of which they pay less tax to the government. However, these legal maneuvers can drastically minimize tax obligation, which is also listed on Heckmeyer's and Overage study, which was made in 2017. Furthermore, such strategies, though they are legal, often bring scrutiny from the public and also from the regulators as well. So beyond this, we are also going to talk about some keywords why this dispensi might take place. So when the company has tax losses from the previous financial year which is carried forward against the current financial year, such uh, cases may arise as well. Also, certain income such as dividends given to the shareholders or the to the shareholders may be exempted under specific condition by the will of every higher authorities involved in the company. Also, some sources of income such as capital gains made by the sale of asset, which includes lands or debentures, etc., may not be subject to income tax as well.
Hello everyone, my name is Suman Raut, student ID 2022009961, and today I am going to present on the topic of incurring a loss for tax purpose and the recognition of tax related asset. Incurring a loss for tax purpose can lead to the recognition of a tax related asset in the financial statement. A tax loss can be carried forward and used to offset the future taxable profits. Under Australian accounting standard, a deferred tax asset is recognized for the carry forward of unused tax loss and unused tax credit to the extent it is probable that the future taxable profit will be available against which the unused tax losses and unused tax credit can be utilized. The amount of deferred tax asset is calculated by multiplying the amount of the tax loss and the tax credit by the tax rate that is expected to apply when the losses or credit is used. For example, if a company has a tax loss of 100,000 and the current tax rate is 30%, then the company would recognize a deferred tax as a $30,000. The deferred tax asset would be shown on the balance sheet as an asset and would be reduced as the tax loss is used to offset the future taxable profit. It is important to note that the recognition of a deferred tax asset is a matter of judgment and should be based on the best available evidence. If there is a significant risk that the company will not be able to use the tax credit, then the deferred tax asset should be recognized. Thank you. Now I'd like to pass it to Ashok. Thank you.
Hello everybody, it's me Ashok Pandey, my student number 20210122831. I'm going to talk about actions needed when tax rate changes. Some of the few actions needed are review the tax law amendments. For it, local, state and federal levels should do review on it, usually when the tax authorities will disseminate the information through the official publications website or announcement. Update tax planning. In order to tax planning, we might need to reevaluate whether to recognize revenue or when to make the deduction. Estimated tax obligation. For it, in order to determine our anticipated tax obligation based on the new tax returns, we will be better to able to comprehend how it could affect our finances. Adjustment payment and withholding. Review our tax deductions from the paychecks or projected tax payments for ourselves to be sure if they are in the line with the new tax rates. Keep accounting records up to date. We should update accounting records to the form to reflect the new tax rates. If any, it must be adjusted. Examine investment techniques. We should think about how shifting tax rates could influence our choice of the investment. Get in touch with taxpayers. For this section, we should fully grasp the effort of the changes of the tax rates on our unique circumstances. Speak with the tax. Revision legal documents. For it, we should be careful to revise any legal paperwork to reflect the higher tax rates, including contracts, planning papers, and compensation agreements. Second last is maintain compliance. In order to maintain compliance, we should keep precise records and the paperwork back to our tax computation and filings. To prevent fines and legal repercussions, compliance with tax regulation is essential. Last action that is needed when tax rate changes is observe upcoming changes. For it, tax rates may fluctuate from time to time when the governmental or economic cases. We should keep an eye for the changes in tax rates in the future and be ready to adjust when necessary. Thank you very much.